Remember the last time we were here? The world was
When
a crazy
was that?
place.
How long ago was that?
It was a little over a year. I remember shooting in the depths of the COVID drawdown.
Yeah.
Yeah.
He's better looking in person.
I'm less tired now, that's for sure.
So for our first day back here, we wanted to talk about the Fed and the press conference from last week. There was a lot of Fed speak last week and this week, and we wanted to just sort of walk through what Jerome Powell has said and digest some of that information and give our take on the situation and what really we think is how it's going to play out.
Yeah, the Fed's quarterly meeting, wrapped up on the 16th. At the quarterly meetings, they give their economic projections and the dot plot. And the dot plot basically shows what all the FOMC members expect short-term interest rates or the federal funds rate to be at various points in time.
Right.
And so the dot plot is eagerly awaited. And, it's really been a long time since the dot plot mattered because basically since the last time we were here shooting, the dot plot has just showed no rate hikes ever,
right,
effectively.
Yeah.
And now we're getting to the point in the economic recovery where now the Fed does have to worry about potentially withdrawing stimulus, raising rates, tapering purchases. So Fed meetings are getting more exciting. And Jerome Powell kicked off the press conference by basically saying the dot plot does not matter. So, quote unquote, no one knows with any certainty where the economy will be a couple of years from now.
Right. And let's just, for the viewers, talk about the dot plot.
Dot plot is objective evidence at how bad the Fed is at predicting where short-term interest rates are going to go. So it's great. So at every quarterly meeting, each FOMC member will have their own projection as to where the federal funds rate will be at various points in time. Each FOMC member's projection shows up as a dot. And you'll see for 2021, year-end 2022, 2023, and then longer term where the dots pan out. So it gives the market an idea of the collective wisdom of the Federal Open Market Committee.
Right.
And the movement we saw at this meeting was that the median dot at the end of 2023 went from 0 to 0.625%. So about 2.5 rate hikes from where we are now, which is a decent sized move. Taking it all with a big grain of salt.
Right.
But it shows the Fed now is actively talking and thinking about when are we going to achieve liftoff? When are we going to raise interest rates off of the zero bound?
Is it fair to say that not all Fed governors are created equal? And really what matters is what just a few of them, including primarily Jerome Powell, thinks?
That is correct. Every FOMC is constructed differently. Back in the Alan Greenspan days, we know that if he had a dot, it would be the largest dot. And that's all that really mattered. Apparently, Jerome Powell is much more democratic. But this is not a uniform path of policy. These are just individual projections. There's no saying that the actual path of policy will follow the median dot. One of those dots may end up being the right dot, which means interest rates at the end of 2023 could be anywhere from 0% to 1.5%.
Right.
Which is not that much new information.
And given what they ended up, how they give context to the dot plot, this is something that changes regularly. It's not something this is not a path that stays the same.
Right.
So what would a viewer expect to see this evolve? What would change the evolution or the slope of this dot plot?
Yeah, so generally the Fed is reacting most of the time in a lagged fashion to economic growth, inflation expectations, and projections for the job market. So you would look at this dot plot and you'd say at the end of 2023, apparently a lot of FOMC members would expect that the economic growth has basically recovered. Inflation is steadily running above 2%, and we have basically achieved full employment, which is consistent with an unemployment rate around 4%. So saying victory, let's start to raise short-term interest rates. That's what these dots effectively mean in the real world.
Mm-hmm. Okay. And all by 2023.
By the end of 2023.
By the end of 2023.
Yep.
Yeah. So maybe just to dig a little deeper on this idea, what are the things that the Fed would look at that would adjust these plots significantly up or down from here?
So if the Fed were to think that inflation, this spike in inflation we've seen is not transitory, in fact, it's going to run away, then you would see dots start to move up to fight inflation, raise short-term interest rates more aggressively to reduce inflation. So if there's expectations for more inflation, you should see some dots move up. And similar for the recovery in the jobs market.
Mm-hmm.
If the pace of the jobs recovery were to exceed expectations and we get to full employment quicker, you would see the dots move up as well. And the opposite is true.
And what, if anything, can we see by the divergence, which is fairly significant amongst the different FOMC members?
Yeah. So
how can they see it so differently?
Right. Yeah. So they have different districts that they are operating in. They have different economic forecasting tools. And then generally they're defined as hawks or doves. There's a common recognition that on an FOMC, you have some members that just generally have a hawkish bias, which means they're going to favor fighting inflation and raising interest rates more rapidly, and some that have a dovish bias, which would imply they're more in favor of leaving interest rates lower for longer. And those biases play out here, as well as diverging opinions on the pace of inflation and the jobs recovery.
Mm-hmm.
So,
which change week to week, month to month.
Yeah.
All right, so the next interesting part of the transcript focused on tapering. So let's talk about tapering first and what tapering is, what it means. I don't think a lot of people understand the mechanics of tapering and how it impacts anything in the market.
Right.
So let's start with that.
Yeah. So logically, before the Fed hikes interest rates, they're going to start the process of tapering. This is the same process they went through in 2018 time period, which basically, as a reminder, the Fed right now, every month, is purchasing approximately $120 billion worth of treasuries and mortgage-backed securities. And when you taper that, you reduce the amount of monthly purchases at a steady rate. Mm-hmm. So you're still growing the balance sheet. The Fed will still be buying assets, but doing so at a slower and slower rate until they're buying nothing every month. They're just reinvesting maturing principal payments on their balance sheet.
So let's go to that slide we have here. Right here, we're showing sort of where we sit today.
Assets, yeah.
And where we're projected to head to, right?
Yeah.
And this is assuming a tapering of?
So this assumes what is starting to become consensus, which is the Fed will start tapering the pace of asset purchases next calendar year, tapering $15 billion at each of the 8 FOMC meetings throughout the year. Meaning you would go from $120 billion in monthly purchases in January down to 0 by the end of 2022. That has become consensus. Mm-hmm. So that's what that green line represents.
So we would end up somewhere with a Fed balance sheet around just under 10 trillion.
That's right. We would go from 7.9 trillion to 9.6 trillion, which that change is generally viewed right now as sort of hawkish, as not very supportive of monetary conditions, because this is in essence starting to take the punch bowl away. Mm-hmm. But in the act of taking the punch bowl away, the Fed would be adding $1.7 trillion to their balance sheet, which is the exact same size as quantitative easing 3, which at its time, which was 2013, 2014 time period, was the largest monetary stimulus experiment we'd ever seen.
Right.
So that's what taking the punch bowl away looks like in a post-COVID world, apparently.
And so let's say they can't taper.
Yeah.
Where does this line end up?
It would keep going up sort of in a linear fashion at 120 billion per month. And that's a real possibility. This is what they're doing. They're taking the market's temperature. So Jerome Powell said, you can think of this meeting we just had as the talking about tapering meeting. Let's throw that out to the market and see how they react. And they took it in stride, which means now the Fed needs to take the next step, which is actually talking about tapering.
Right.
They'll see how the market reacts to that. Then if all goes well there, they'll take the next step, which is actually announcing the taper. And if that goes well, they might start the first leg of the taper, which would be at the January FOMC meeting, January 2022. And they would announce they're going to reduce the pace of monthly asset purchases from 120 billion to 105 billion per month. And then we'll see how the market takes it, right? So, it wasn't at this press conference, but at past press conferences, Jerome Powell's been quoted as saying, sort of like we're walking around with the lights off. You want to move very slowly with your arms out ahead of you so you don't hit anything, which once again portrays a tremendous amount of confidence. But that goes to show this will be a slow, methodical process. At each point, pausing to take the market's temperature.
You just don't want to trip over $9.6 trillion because that would hurt.
And exactly, and also, 9.6. You have to put that into context. That's approaching half of GDP. Half of GDP.
Yeah.
So nowhere close to Japan, but we're also a much larger economy than Japan. But that's a huge number.
And so maybe for the viewers, just explain what tapering does to the economic system and to the financial markets.
Yeah. So the reason why the Fed would have to buy assets is because something like COVID-19 happens. Interest rates are already at zero. Everyone's wondering, does the Fed have any more ammunition? And they do. They invented it in the global financial crisis. They can start doing outright asset purchases. They're just going to start buying longer-term treasuries, agency mortgage-backed securities, et cetera. On a very high level, what this does is it eases financial conditions. And what does that mean? That means interest rates, especially on corporate bonds, treasury bonds, they go lower, which makes it much easier for companies and governments, very importantly, to refinance and roll over their debt, prevent things like bankruptcies. Credit spreads get much tighter. The dollar generally gets weaker. All of these things make financial conditions for everyday businesses, corporations, et cetera, easier so they can make it through any difficult time period like COVID. We're certainly not in a COVID market environment anymore. Also, asset purchases provide stability to financial markets. It helps financial markets function properly, which apparently means they should be going up all the time because that's when this happens.
That's the new normal.
Right. So it does all of those things.
That's great. So I think that's a good point you made, and we'll circle back to that. But let's look at the labor market comments that they made, specifically where they're wanting to take the labor market before they feel like it's back to normal.
Yeah. So when Jerome Powell, in the press conference, one of the first questions was about the recovery in the labor market, which has been slower than a lot of folks have expected, and we did a very comprehensive video on that.
Right.
And he came out and immediately exuded confidence that the labor market recovery would be strong. He has no fears about the labor market. Very confident in a very, very strong labor market recovery. And going back to the dot plots and the dynamics, what that basically means is it has a hawkish bias to it. That's a hawkish statement. And that means perhaps out on the course of this dot plot, rate hikes will come sooner and quicker. The taper might come quicker because we're not worried about the labor market recovery. So if you were wanting the Fed to, take their time and not taper, you would have wanted him to come out and say something like, we are very concerned about the pace of the recovery in the labor market, and we're going to continue to provide support. Mm-hmm. He didn't say that this time.
Right.
Didn't say that. So a little more hawkish than maybe markets wanted.
And if you watched any of the testimony that he gave, there's a lot of political undertones, specifically with the labor market, and how potentially, as his term's drawing to an end, how he'll play this card.
Yeah. So
maybe comment for the viewers on what the political pressures on him are to improve this metric.
Yeah, the Fed has become increasingly politicized and that have been painted with a brush that perhaps they are supporting income inequality and a uneven recovery in the labor market. Because historically what they would do is, hey, we have 4% unemployment, let's hike interest rates. But that does not mean that that's 4% unemployment for everyone in the economy. There are certain cohorts, demographics, races that generally would have higher unemployment rates. And so as the Fed's role gets politicized, Jerome Powell has a lot of pressure to continue to do whatever he can to make sure the labor market recovery is very strong and even, and there is equity in it. And that's a tall order for somebody who's already lowered interest rates to zero and is buying $120 billion in assets. But he needs to at least show that that is what he's trying to do.
Right. And so his statement says 1 to 2 years out. Yeah. So 22, 23, we'll be back to this somewhat level normal employment.
Right.
And given that, and given his comments on tapering and the dot plot, if you put all those together, what makes logical sense for the path forward for the recovery? Are we peak recovery now? Are we starting down, or are we still early cycle?
Well, we would say that we are still very early cycle, and there really isn't much of a benefit for the Fed to come out and say something like this at this point in terms of markets and the recovery. If you want the recovery in the labor market to be stronger, well, then you should just not think about hiking interest rates yet, and you should continue purchasing assets. Those are your tools.
Right.
So you have to support that. So, would bet that Jerome Powell is in a very difficult place where he has to express confidence in the recovery of the labor market, but at the same time doesn't want to give the idea that he thinks the job is done or it will be done in 2 years. Mm-hmm. So very difficult position. Had to talk out of both sides of his mouth, basically.
So let's move on to the I word, inflation. I mean, I can't think of another word right now that is more discussed in the media and misunderstood than inflation. So take us through what they said about inflation.
So Jerome Powell did make a point to express over and over that their base case is that this spike in inflation will be transitory and it is tied to the reopening and supply chain disruptions, which it is consistent with our view on the spike in inflation and has now become the market's view, increasingly so, that this will be a temporary spike. Towards the end of the Q&A in the press conference, he seemed to lose that a little bit or felt the need to come out and say that, hey, we actually are monitoring inflation and it's not our base case that inflation would run away or inflationary expectations would cement themselves and we would have an inflationary spiral. Not the base case, but it's something we're monitoring and it's something we are prepared to act against.
Right.
Which would mean raising interest rates and reducing asset purchases, right?
So a couple of questions to elaborate on. When we say transitory, I think we would say transitory, yes. Trending, yes. What's the time frame?
Yeah. So the great thing about inflation is it's primarily a year-over-year metric. And if inflation is high now, it's going to be very difficult for it to be high a year from now.
A year from now.
So a year from now, you think, oh, we have this big increase in prices right now. Take used car rental, okay? Up 82% over the past year. Well, I would probably bet if there was a way to play used car rental prices that they're going to be flat to down from here to next year because it's a year-over-year metric.
Right.
And so you think 12 months out, you should probably see disinflation, meaning inflation's still positive, but lower than it is now because of how prices are measured, year-over-year changes. So 1 to 2 years is transitory in our view. And then you should be able to trend somewhere around 2% or slightly above 2% after that.
Right. I think we've done a lot of work on inflation, and I think we've shown that it is primarily COVID inflation that's driving these numbers.
Exactly, yep.
So the big market reaction to this was
the yield curve. Yeah.
The yield curve changes. So take us through what happened here.
Yeah, so if we look at the yield curve has a tremendous amount of information about inflation, about the jobs recovery, about the path of asset purchases and interest rates. And this is what you got after the press conference. So, there were financial media sources saying, oh, this is like a tantrum, a taper tantrum. We're talking about tapering, and this is a tantrum. This is nothing like the taper tantrum from 2013, where Ben Bernanke really messed up in a press conference, and interest rates, particularly at the long end, shot up really rapidly. This is what happened. You actually saw a flattening of the curve. What we mean by that is shorter term interest rates on the Treasury curve went up. Those are pricing in, hey, the Fed might hike rates in the next 2 to 3 years. They might actually do it. Okay, so the yield on a 3-year Treasury note should go up a little bit. And the longer term, you see those yields came down. And that's pricing in, hey, the Fed might actually care about inflation running away. And they might actually do something to prevent that. So when you look out to the 30-year, that's saying, is inflation over the long term going to run hot? Is it going to run at 3%, 4%, 5%? And with those inflation comments that Jerome made, hey, this is something we're monitoring and worry about, longer term rates came down. This is not a huge market move. This was very much overplayed in financial news outlets. Everybody likes to talk about the Fed.
Yeah.
The one thing that was notable is the degree of the flattening. That is somewhat meaningful. So the 3-year note, for example, went up in yield about 15 basis points, 0.15%, and the 30-year went down about 10. That flattening is somewhat meaningful because there are a lot of market participants that trade various asset classes like equities that have quantitative models that are based on the steepness of the yield curve.
Right.
And so you saw a knee-jerk reaction where it's, oh, wow, the yield curve is flattening. Sell your economically sensitive,
sell your financials,
lower valuation equities and buy growth stocks.
Right.
Just a knee-jerk reaction. This once again is not significant, and that's started to unwind since.
Yeah.
Those types of trades.
And let's take a quick to your point on longer term inflation expectations.
Mm-hmm. Yeah. So this blue line represents what the bond market thinks inflation will be over the next 5 years, and this is a time series. So as we got into May, these were sort of like peak inflation fears, where the bond market was actually pricing in 2.77% inflation over the next 5 years. That's a pretty hot number. It's the highest in over a decade. Mm-hmm. But before the June FOMC meeting, which we have marked on the chart, these expectations were coming down. This was the market getting on board with the transitory narrative around inflation. The market was getting very comfortable with inflation, that it wasn't going to be running away. Right. And so there probably wasn't a reason necessarily for Jerome Powell to have to come in and say, this is something we might be worried about long term. It was just, maybe one comment too many.
Yeah. It was nice to see the market sort of take to the narrative.
Yes.
All right. Let's go back to something that's a little more
wonky.
Yeah, wonky, arcane, in the weeds. But does have a big important function and did impact the markets significantly, the plumbing of the markets.
Yeah.
And it's the reverse repo facility. And we'll take our time with this to explain this because it's clear as mud here. But it was a big deal. Mm-hmm. And there's a lot of components like the Treasury General Account that's affecting this.
Yep.
So walk us through what the Fed did and why they did it.
Yeah. So the reverse repo facility, basically what they did is they adjusted the rate on the reverse repo facility up by 5 basis points. This 95% of market participants just glazed over this. I do not care. But basically what is happening is there is so much cash and so much liquidity in financial markets looking for a home. And it's pouring into things like money market funds, right, as you would expect. And these money market funds need to go out and invest in something. And these are short-term, very low-risk instruments like short-term Treasury bills, 1 month, 3 month bills, things like that. Mm-hmm. And so you have all of this demand for bills, Treasury bills. And what's actually happening is the Treasury isn't issuing that many new bills. And so there's a shortage of supply. And when the demand for bills exceeds the supply of bills, what happens is the interest rate on bills goes down. And so at the short end, you've seen tremendous downward pressure on very short-term, overnight type interest rates, to the point where the concern is actually that the federal funds rate could go negative. Not because the Fed set it at negative, but just because of these market dynamics.
Pressure, right.
And so you think, well, why doesn't the Treasury just issue more bills? That's something they could do, but the Treasury has a whole bunch of money sitting on account at the Fed in something called the Treasury General Account. About $2.5 trillion for a rainy day type of a thing. And Janet Yellen has committed to, instead of issuing new bills, to just fund government operations by just drawing down the Treasury General Account. And that's exacerbating this issue. So you have all these money market fund managers complaining, I have so much cash, I have nothing to invest it in that gets me any type of reasonable yield.
Right.
And so what they're doing is parking whatever securities they have or cash they have at the Fed through the reverse repo facility. Repo facility is when I give you securities, you give me cash. Right. Reverse repo facility is I give you cash,
right.
Fed, you give me securities. And they were doing that to get nothing. Now they get something. They get 5 basis points.
So there was a rush, right?
Yeah.
To get that 5 basis points.
Yes. Yes.
So maybe let's start with, why is there so much cash?
Yeah.
We've had clients say they can't even put their cash in the bank anymore because the banks don't want it.
Yeah.
Explain that.
Yeah. So part of it is, so first is the money supply has increased at a larger rate than any other time in history.
Right. As we've shown. Yes.
Yeah, exactly. Money has grown tremendously. The other part is banks have restrictions on how much cash they can take in. There are, not going to name any banks, but there's one bank in particular that the Fed has said they cannot grow their assets anymore. They're not allowed to. And so they would maybe love to take your cash and make loans with it, but they actually can't due to regulatory reasons.
Right. So
you cannot park your cash with me. And that cash is going somewhere, and it's primarily going into things like money market funds. Where else are you going to park your cash, right? So that's at some banks that have asset restrictions. Other banks that, due to something called supplementary leverage ratios, which also is a regulatory number thrown on banks to make sure they don't grow too big in assets, they all got relief from that during COVID. They didn't have to comply with these ratio requirements, which meant they could grow their balance sheets as big as they needed to, reserves and treasuries. Well, those have been reinforced again. So now banks are saying, I can't take this cash. Right. I can't. I'm actually going to pay a penalty if I take this cash.
So here's a question that I don't think a lot of people appreciate. Why don't the banks just lend more? Yeah. I mean, that would solve some of this problem. Yeah. And question 2 is, the Treasury has been drawing down their TGA. So I think they've got like $300 or $400 billion left, perhaps, to go. What happens when they draw it all out? Will this self-correct?
So yes. So to the second part of the question, the Treasury likes to keep about $500 billion at the TGA. And so once they approach that level, which they're getting somewhat close, that means if they're going to fund operations, they just need to issue new Treasury bills. So we should get to that point, and that should put upward pressure on very short-term interest rates. So these problems are going to start going away in relatively short order. So it was interesting that they chose to do this now. It seems a little late. And then the first part of the question was, why don't the banks just lend the cash? Well, a loan is a risky asset. And so that counts against your supplementary leverage ratio as well. So that's one reason they don't want to get too big. And then the other reason is, who needs a loan at this point? I mean, I say that a bit tongue in cheek, but there has been so much capital, so much money created. Interest rates are so low that it's from a lender's point of view, it's difficult to find folks that are still demanding loans that are a very good credit standing and have strong balance sheets and things like that. I mean, you know, everybody's basically had a loan.
Everyone who can do something productive with a loan?
Yes, good point. You can do plenty of unproductive things with free money.
The question we get is, why does the taper matter? Why doesn't it matter?
And so the answer to that is the taper will matter until the Fed reverses course. So it sort of matters until it doesn't, which is a bad answer. But basically what we mean by that is we talked about how the Fed is going to take this very slowly and methodically. They know Ben Bernanke had a taper tantrum. They don't want to repeat that. They don't want to do anything to mess with the economic recovery. And they don't want anything to disrupt what's going on in this chart, which is the blue line is corporate debt to GDP. It's above 50%. We don't typically get to over 50% corporate debt to GDP. That's a lot of debt.
A lot of debt.
And the only real reason why we can have over 50% debt to GDP is because of the green line. So the cost of that debt, or the interest rate on corporate bonds, is near all-time lows. If corporate bond yields were to rise, say they were to double or triple, a lot of companies on the margin would not be able to afford their debt loads. And you would have the credit cycle reset. That would mean very bad things for the economic recovery. So the Fed knows this. They are in a very difficult position. It's a high wire act. If this is how we think it'll likely play out, they will taper for as long as the market will let them. And then they will stop because they have to.
Right.
Because there's no way you can achieve price stability and full employment if the credit cycle is turning over.
Because what happens when the credit cycle turns over?
Well, you would get an economic recession,
bankruptcies,
layoffs, so on and so forth, deflation,
deflation,
all of those bad things. So that's our general view. The Fed will taper for as long as the market allows it, and then they will stop. You recall the last time they tapered, it worked.
Yep.
They got through the taper. There was some volatility for sure. Then they had to maintain the size of their balance sheet for about 3 years.
Right.
And then they actually tried shrinking it. And that lasted about 4 months.
Yeah, it didn't go so well.
And then they had to reverse course. And because market volatility picked up, and they're ultimately listening to markets. So.
And at what point, I mean, that was a third or over a half of where we are today?
Yeah.
So at what point does the ability for them to reverse course just become not an option?
Well, I mean, you could ask Japan about that. It's exactly right. It isn't really an option at this point. Yeah. You would have to see over this time period corporations deleveraging their balance sheets to the point where they could take on higher borrowing rates and still be fine. And so that's not our base case for sure.
And maybe a follow-on question. What does the tapering effect on rates do to the fiscal situation we're in?
Great point. So we're talking about the corporate bond market, which tapering purchases of treasuries would indirectly impact corporate bond yields, but it would more directly impact treasury yields. And somebody needs to buy the debt, right? So we talked about how banks can't expand their balance sheets because they're subject to things like supplementary leverage ratios. Well, treasuries also count against your supplementary leverage ratio calculation, unfortunately. So banks are somewhat limited in how many treasuries they can buy. And so there really are only a few buyers of treasuries. I mean, they're very large, but you have the Fed. You have the big money center banks in the US, the Fed member banks, which have to, at auction, buy treasuries.
Primary dealers, yep.
They're the primary dealers. And then you basically have foreigners. And foreigners, they're fair weather buyers.
Correct.
If the yields are attractive and they think the dollar's going to be stable, they'll nibble at it, but they're way less of a player than they were before. The banks are limited. They have these balance sheet restrictions put on them by governing bodies that say they can't take down that much. This was a problem in 2019. They ran into capacity issues, and the Fed had to come in and buy again. Mm-hmm. And then you have the Fed, and they're trying to say, no, we're going to do less of that. So this is all happening. You're wondering who the buyer is going to be at the same time when obviously we're going to have record new Treasury issuance because we know what the deficit situation looks like. So the Fed can talk a big game, and they can talk like an adult, but ultimately they're going to have to buy. They're going for the foreseeable future. They are going to have to be a large purchaser of Treasuries as long as U.S. monetary policy functions in the way it does, where the primary dealer banks have to take this on temporarily. The Fed will have to help them out by taking those Treasuries off their balance sheets so they don't run into things like capital charges and things like that. Yeah. So there's no going back.
Yeah, there's no going back. Yeah. Well, we'll leave it there. It's great to be back. It's great to be here with Mike and to be with all of you. So we'll look forward to our next video. And till then, if you have any questions, let us know.